Water is not a political issue alone. It is the most practical test of resilience for communities, farms, and industries across America. In the last decade, droughts intensified, reservoirs fell to historic lows, and cities faced tough trade-offs between pipes, and people. Investors have noticed too, as water scarcity hints rise in price benchmarks, bond ratings, and risk models. With climate shifts and aging infrastructure, the value of a single acre-foot becomes a nationwide lever. If a drought breaks or a river stops flowing, everyday life and national food security both hinge on who controls water today, everywhere. At its core, water rights are legal entitlements to use a portion of a water source, usually for irrigation, drinking, or industry. In many Western states, rights are tied to history, geography, and seniority, meaning older holders can divert before newer residents. When supply shrinks due to drought, legal frameworks push allocations down the list. Markets notice, developers, farmers, and utilities compete for limited flows, often trading rights or quantities via water banks, leases, or futures-style contracts. The result is a de facto commodity market where the scarcity signal appears in storage levels, rainfall forecasts, and the price of access itself rather than a traded share price. To understand today, you must trace water back to rivers, aquifers, and centuries of policy. In the arid West, mining, ranching, and irrigation carved priorities years before cities grew. The doctrine of prior appropriation dates to California Gold Rush era, where senior users gained preferred access, giving rise to the proverb, "First in time, first in line." Federal projects in the 20th century, from the Hoover Dam to the Central Valley Project, reshaped supply by moving water across regional boundaries. Over time, climate variability, groundwater extraction, and aging infrastructure turned water into a political, economic, and financial stress test today. Spot prices for water are not widely published like oil, but regional markets exist across the West. In drought years, irrigation districts auction allocations, trading credits, or leasing water from farms to cities, creating price signals akin to a stock market with weather as the main catalyst. California, Arizona, and Texas already saw multi-year volatility, with storage in Lake Mead and Lake Powell at or near record lows. For investors, water assets appear in mutual funds, ETF baskets, and agricultural lease rates used by agribusiness to hedge drought risk. Banks price projects against coupon rates and scarcity assumptions, mirroring energy risk models. Farmers fight for access to irrigation while city utilities plan long-term supply. Agriculture consumes about 80% of Western water, so farm revenue, crop choices, and even land values ride on every seasonal forecast. Utility districts borrow against future allotments. Airlines and beverage companies face higher input costs if drought worsens, and farmers partner with insurers for climate risk. Private equity and infrastructure funds chase storage projects, pipelines, or groundwater rights, creating a web of players across rural and urban economies. Retail investors join grassroots groups championing local water efficiency, while municipal bonds price resilience against dry years today. Water scarcity sits at the intersection of climate, population growth, and global supply chains. Drought stresses in the western United States ripple into food prices, supplier risk, and international trade, where farmers import crops and commodities respond to scarcity. Global capital flows into climate adaptation projects, desalination, and watershed restoration, while federal budgets are strained by aging infrastructure and drought relief. Insurance costs rise as flood and drought events alter correlated risk. Regulators debate water reuse, cross-border agreements with Mexico, and interstate compacts that determine who gets what when. The macro backdrop is a reminder that scarcity is systemic. Smart money is testing water as a diversified edge, not just a regional scarcity story. Pension funds and endowments explore infrastructure funds tied to storage, pipelines, and reuse facilities, seeking inflation hedges and predictable cash flows. Public water utilities issue bonds with drought resilience incentives, attracting risk-aware buyers. ETFs and mutual funds list baskets of water assets or agriculture exposures, though liquidity remains thinner than traditional commodities. Retail investors watch water-intensive companies and fertilizer producers using crop insurance and weather data to time entries. As climate risk rises, the smart move is often to blend traditional equities with specialized water plays. Any asset can overheat, and water is no exception. If drought ends quickly, storage rebounds unexpectedly, projects stall, and liquidity dries up, prices could crater as expectations unwind. A single policy reversal, court ruling, or federal bailout could flood the market with supply, or alter seniority rules, hurting long positions built on scarcity. Overlapping water rights with oil or mineral rights creates custody disputes and legal challenges that slow trades. Climate adaptation projects may fail to deliver promised efficiency, or groundwater rules restrict extraction, leaving stranded investments. In a fragile system, a mispriced risk compounds financial stress across sectors globally. Retail investors can approach water as a thematic add onto existing portfolios, not a guess on a single drought. Start with education. Track regional storage levels, rainfall forecasts, and river compacts, then consider diversified exposure through climate-focused funds or infrastructure equities with transparent drought plans. Use stop-loss discipline and avoid over-concentration in any one project. Seek seasoned managers with a history of liquidity and governance in critical assets. Hedge against downside by pairing water stocks with commodity or agricultural producers. And stay aware of policy changes that could shift access rules. Patience and measured risk beats hype and hype-driven speculation. Looking ahead, water scarcity could redefine how we value land, crops, and cities. Climate trends suggest hotter summers and deeper drought cycles in major basins, while technology shifts improve water efficiency and leak detection. The biggest gains may come from proven infrastructure, reuse, and storage projects that turn risk into predictable cash flows. Regulators, corporates, and communities will need better data, stronger governance, and smarter pricing to avoid conflicts over access. If you want to stay ahead, monitor policy changes, invest with discipline, and diversify into resilient water assets. If you found this valuable, subscribe to the Commodity Brief for weekly insights on alternative assets and commodities.